If you hold investment property inside a discretionary family trust right now, the federal budget that landed in May 2026 has just changed your financial future. From the 1st of July 2028, your trust will be hit with a brand new 30% minimum tax. The income splitting strategy that made family trusts the structure of choice for Australian property investors for over 40 years is effectively dead. Today we break down what the new rules actually mean, who's affected, and what you need to do about it. First, let's quickly explain why family trusts have been so popular. A discretionary trust gives the trustee flexibility to distribute income to different beneficiaries each year. For property investors, this has been enormously powerful. If you own a rental property in your personal name, and it generates $50,000 of net income annually, that $50,000 is added to your taxable income. If you're on the top marginal rate, you pay around $23,000 in tax on that rental income. But if the same property sits in a discretionary trust, the trustee can distribute that $50,000 across multiple family members, a non-working spouse, adult children studying, retired parents, each receiving income up to the tax-free threshold or in lower brackets. The total tax bill on the same $50,000 can be reduced to less than $10,000. Over a property investment career, this income splitting has saved sophisticated Australian investors millions of dollars in tax. The federal budget has decided that strategy has run its course. Here's how the new system works. From the 1st of July 2028, discretionary trusts will pay a minimum 30% tax at the trustee level on the trust's taxable income. The trust can still distribute income to beneficiaries, but those distributions carry franking credits reflecting the 30% already paid by the trustee. Beneficiaries can offset these credits against their personal tax liability. The practical effect is that the income splitting benefit is largely neutralized. If a beneficiary is on a marginal rate of 45%, they pay an additional 15% on top of the 30% already paid by the trustee. If a beneficiary is on a marginal rate of 19%, they cannot get a refund of the excess credit. The 30% paid by the trustee becomes the effective minimum tax rate. Distributing income to lower bracket family members no longer reduces the trust's overall tax burden below 30%. The flexibility remains, but the tax saving disappears. Now, there are some important nuances. The new minimum tax applies to trust income, but the specific definition of what counts as trust income for these purposes is still being finalized. Capital gains within trusts will be treated specifically, and there may be interaction with the broader changes to the CGT discount system from July 2027. Testamentary trusts, which are trusts created by a deceased estate, will continue to receive different treatment under existing rules and are not subject to the new minimum tax in the same way. Special disability trusts also retain their concessional treatment. Small business restructuring rollovers will be available in limited circumstances to allow trust restructuring without triggering immediate CGT consequences. None of this changes the headline reality: the era of family trust property investing as a primary tax minimization strategy is over. The strategic question every trust-owning property investor is asking right now is what to do next. 3 options. Option 1. Do nothing. Existing trusts can continue to operate after July 2028, just with the new 30% minimum tax applying to income. If you hold property in a trust primarily for asset protection rather than tax minimization, the trust may still make sense. Asset protection benefits don't disappear with the new tax rules. Option 2. Restructure into an SMSF. SMSFs are excluded from all the major budget changes. They retain the 1/3 CGT discount, continue to allow negative gearing strategies, and are not subject to the new minimum trust tax. For investors with sufficient super balances and long-time horizons, moving property holdings into an SMSF can dramatically improve after-tax outcomes. The catch is significant. SMSF property requires limited recourse borrowing, has strict compliance requirements, and locks the asset away until retirement. Option 3. Restructure into a company. Companies pay a flat 30% corporate tax rate, which is the same as the new trust minimum. But companies do not receive the CGT discount and have different distribution rules through franked dividends. For some specific investor profiles, a company structure may produce reasonable outcomes, but it's rarely the optimal choice. The timeline is the most important thing to understand. The new minimum tax applies from the 1st of July 2028. You have approximately 2 years from budget night to make restructuring decisions. That sounds like a long time. It is not. Restructuring property out of a trust typically triggers capital gains tax, potential stamp duty in some states, legal costs, and significant complexity. Many investors will need to model multiple scenarios with their accountant, get tax and legal advice, potentially conduct property valuations, and execute restructuring transactions carefully. 2 years is a realistic window for thoughtful planning but a tight window for rush decisions. Don't wait until the first half of 2028 to start this conversation. 3 urgent priorities for trust-owning property investors. First, get a current valuation of every property held in your trust. You need to understand what CGT consequences any restructuring would trigger. Second, model your specific income situation. The new rules hit hardest if you have been distributing significant trust income to low-bracket beneficiaries. If your trust income mainly goes to top-bracket family members already, the practical impact may be modest. Third, engage a specialist tax accountant, ideally one with significant trust restructuring experience, within the next 6 months. This is not a conversation for a generalist accountant doing your annual return. The decisions matter, the deadlines are real, and the options are complex. The 40-year run of family trust property investing as a primary tax strategy is ending. Smart investors are already booking restructuring conversations. Unprepared investors will be caught flat-footed in 2028. If you found this useful, hit subscribe. We break down Australian property and tax changes every few days. And if you want to see exactly how SMSFs compare to other property holding structures under the new rules, click the video on screen. See you next time.